Hello, everyone. This is Jelena Ogilvy, Partner and Director of Business Development here at Principal Wealth Partners. Well, what a year we've had. We recently crossed the 1-year anniversary of the pandemic, and it's incredibly ironic that despite a massive global pandemic, one of the sharpest recessions on record, and fastest equity declines on record, the 1-year return on the S&P as of March is the best in 30 years. We hear a lot of questions around where do we go from here? So to help us with this discussion, I'm thrilled to introduce, and to some of our clients, reintroduce Jenny Harrington. Jenny Harrington is the CEO of Gilman Hill Asset Management, which is an income-focused boutique investment management firm based locally here in Connecticut. She is the portfolio manager of their flagship equity income strategy with over 20 years of investment experience. Her resume includes names like Goldman Sachs and Neuberger Berman, and she is sought after by the media as a dividend expert. In fact, was featured in Barron's as recently as March of this year. This is a 45-minute discussion full of nuggets, including in no particular order. First, her view of the market going forward, the challenges, the opportunity, and the volatility that may come with it. Part of the discussion goes into the popularity of social media with examples like GameStop. Second, as Jenny does so well, she balances the conversation, reminding us the importance of fundamentals as the key to long-term success in investing, and refers to two clients that behaved very differently in this past year and their outcomes. And finally, the importance of dividends, the philosophy behind her portfolio, and even the possible effect of dividend taxation going forward. Enjoy. Well, welcome, Jenny. It is great to see you again. So you and I were talking about this webinar, and we were reminded that you were with us a little over a year ago at the Madison Beach Hotel, and we were aware of COVID. We were socially distanced. We were joking about shaking our hands with our elbows and how awkward that felt, not realizing that we would literally go into quarantine days later and we would still be shaking our hands with our elbows. So it's good to see you again.
It's good to see you too.
So now we have the continued distribution of the vaccine. We're seeing this light at the end of the tunnel, and we thought it would be really a great opportunity to circle back with you to get your view on the markets and how you as a portfolio manager think around investing during times like this.
Great. Thanks. I know, I can't believe the uncanny timing, right? It was when we did this event last year, it was the night that Tom Hanks was diagnosed with COVID. And I remember thinking that elbow bumps were ridiculous, driving home back to Norwalk and listening to the radio and hearing that Tom Hanks had it and thinking like, oh my God, this is serious. Things are going to change. And boy, did they.
Amazing.
So thanks for having me back. It's been, in a lot of ways, it's been a really wonderful time as a portfolio manager. Very, very difficult, but very wonderful in that it forces you to know who you are, where you are, how you invest, and it also gives a really good stress test to your style of management. So in addition to managing through the past year, there's been a lot of really contemplative reflection that's gone on here and a lot of thinking through lessons learned. How would we do it differently? What did we do right? What did we do wrong? So I put together some slides for you all, and
that'd be great.
Hold on. And as usual, I've already messed up my share screen. Okay, here we go. I found this on Facebook, the next slide that I'm going to share. And it was from a friend of mine posted it, someone who's not a financial services person at all. And it struck me how much this looks like the market. So the top slide or the top thing shows your plan, which is to march along slowly. And when we think about the old truism that the market returns 8 to 10% a year on average over the past 100 years, wouldn't it be wonderful if every month was just about 0.5% return and we could all sleep at night? It would be great. But that is not true either in life nor in your portfolio. The reality is that there's bumps, weaves, all sorts of things along the way. So take a peek at this bottom picture that shows the reality of life, which is it is upward trending, but there's a lot along the way. And please note the uncanny resemblance to the stock market. So I often think, what do they say? Art imitates life. Well, the market imitates life, and the market is life, is the reflection of life and the economy and people and all of that's involved there. So this slide is really important to me because when I think about what we have coming to us over the next year or so, I think that we have more of the same in the long run, which is we have an upward trending market, but there's going to be bumps and weaves along the way. When we think about what's happening next, as we think about this, we start to separate the short term and the long term. And in the short term, we expect there to be a lot more volatility. This is going to come from things like emotions, which we saw so heavily in the last year. The media feeds emotions, both from a social media perspective and a traditional media perspective. Although I'd say in the last maybe 6 months, the social media side of that has really had a profound impact, at least in terms of the noise that we hear, maybe not as deeply in the actual fundamentals of the market. Politics, as we know from last year, right? Because a lot of this presentation last year was about the upcoming election and what would happen if it was all blue, all red, half and half, how that was going to go. So politics affect volatility. There's a lot of structural developments that have come about in the last year, in the last several years, maybe the last decade even, algorithmic and artificial intelligence-based trading programs, the increasing popularity of momentum investing, high frequency trading that a lot of the hedge funds use, the dominance of index investing, the increased use of leverage. All of those we've seen in a very pronounced way, we've seen over the last year have a major impact on the short-term volatility of the market. Then there's black swan events also, again, really reminded of that in the last year, the coronavirus pandemic. And this is an aside, but my partner Greg always says that the cure for the next financial crisis was preparing for the next financial crisis. I think that the way our next black swan event that derails the market is not likely to be a pandemic, because the cure for preparing for the next pandemic will make sure that that's not what derails the market next.
So true.
Yeah, so it's pretty tough. I think one thing to remember, and this is something we talked about a lot last year, I didn't want to put these slides in and repeat too much, but one thing to remember is that volatility offers tremendous opportunity. And some of our best investments probably that we'll ever make came last year, and also in 08, 09. And so that's what volatility gives you. It gives you a lot of craziness, gives you a lot of hardship, but it also gives a lot of opportunity. So we need to, as portfolio managers, be there and be ready to take advantage of that and not be scared of it. When we think about, sorry, I switched slides. Sorry, I want to just put this up because I thought everyone would think it was kind of funny, but someone sent this to me on Twitter the other day. And so on the left-hand side, you have an analyst recommending value stocks on CNBC. On the right hand, you have a Reddit poster telling everyone which stonks, which is like some new slang, are going to go to the moon next. And you really see, when you think about what we saw with GameStop and other stocks like that over the past several months, you think about how popular the social media influence has become on stocks. I think it can scare people and make it feel like the market's broken and that things are scary, but that's not the reality. This is kind of superficial and it's noisy. And the reality is that as we separate out the long term from the short term, and we start to think about the long term, we think that the long term is actually going to be the same as it always was. So we have two of our favorite people to quote. One is Einstein, and this is how we think about the long term, where Einstein says, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." And then Warren Buffett reminds us, "The stock market is a device for transferring money from the impatient to the patient." I think those are representative of the long term. So while we might have all this short-term volatility, the long term is going to be very much the same as it always has been, which is you sit back, you do your homework, you do your work, you behave rationally. And this is one of the best lessons learned from the last year, is the importance of rational behavior. But you do your homework and you know what your portfolio is doing for you, and that's where you come out ahead. So, this is another thing that we showed last year, and I don't think that we can overemphasize the importance of this next slide that I'm sharing with you, which shows the average investor's return over the past 20 years and the S&P 500's return over the past 20 years. So when you look at the 20-year annualized returns, and this is from your alma mater, Julina, JP Morgan, here with the best slides ever.
Love it.
Yeah, but the average investor's return on an annualized basis is 2.5%, and the S&P's return is 6.1%. And the difference between those two is behavior. And so again, this is where I think we need to be very careful with not letting this short-term volatility, this short-term noise get in our heads and mess us up. We need to always remember why that's there. It's short-term, it's noisy. In the long run, You know what's going to behave, what's going to prevail? Good behavior, cash flows, businesses that produce earnings and revenues. In our case, pay individuals dividends. So it's really about behavior. And I'm going to get into that in a sec too, but I want to show you one more slide. This is the hypothetical value of $1 million invested in the S&P 500 over the past 10 years. If you'd been invested for the whole period, that $1 million now would be just about 3.7 million. If you were trying to be cute, if you panicked, if you let your emotions get the best of you, and you missed the best 40 days, you'd actually be down. You'd only have 845,000. If you miss the best 30 days, be $1 million, and so on and so forth. And these are really important. And this was such a phenomenal, sad, hard, but phenomenal lesson that we learned last year. Last year when we spoke to you, it was just as the market was starting to get really crazy and really volatile, but not so bad yet. And we came up with this idea of a panicdote, like an anecdote. We shared something different last year, but now we have a real-time one. And this is 100% true. These are real clients. So last year, things were really scary. The S&P bottomed out at about down 34% on March 23rd. We had 2 clients behave very differently. And I will give myself a pat on the back for doing a good job with keeping almost all except for probably about 2 in the market throughout that period. One of the things, and I'll actually jump in with this, I was going to talk about this later, but one of the things that we learned that was we're reminded of last year, that was so important, was that it is absolutely critical to talk to your clients and communicate with your clients and to have a portfolio created that your clients can know, understand, believe in, be comfortable with, because that can get them from one side of a crisis to the next side of a crisis intact. It can build the bridge. And I realized last year, I could be the best portfolio manager ever. I could be better than Warren Buffett. But if I didn't communicate functionally with my clients and create a portfolio that they could believe in, then everything was for naught. Because a little bit of bad behavior can create long-lasting, incredible pain and negative consequences. So what I really realized, I know Juliana, you and Bob are particularly superb at this, communicating and believing in your advisor, believing in your portfolio manager, having the relationship is just, it trumps everything.
And Jenny, you and your team were incredibly informative in the last year and available to us and our clients. So thank you. That's tremendous.
Thank you. Thanks for appreciating that. Interestingly, when I started at Goldman Sachs, I remember one of the things that they hammered into us, and this was in the 90s, it was just before the dot-com crisis, but one of the things they hammered into us over and over was that in bad times, the best thing you can do is be there for your client. And the worst advisors, the worst portfolio managers hide from their clients in bad times. And I remember that as one of my formative lessons early in my career was the last thing I'm going to do in times of crisis is hide. My job is to be 20, not just to be 20 steps ahead of my clients, which that's my job, but it's to communicate and pass on all of my confidence to the clients. So that, I think that's important, but all the same, even I failed with a client last year. So I had one client who insisted on liquidating his portfolio and he locked in a loss. And throughout the year, he'd feel a little better, panic again, cash out, feel a little better. And I'm pretty good at this, but even I wasn't up for that match. His portfolio ended the year down 25%. Simultaneously, not similarly, simultaneously, we had another client who had sold a building a little while earlier and had been sitting on the cash, just kind of ignoring it. And they said, and this is a really conservative family who did this. And they said, hey, is now a good time to put the money in? They were a little late. It came in April. And that cash that was sent in April, because they were just kind of clear-headed and thoughtful and said, this seems really crazy and really disjointed, they sent cash in. Even with being slow to invest it and legging in slowly, that cash is up 58% from what they invested in April. So it's really important to remember that you want to be like client B, be thoughtful, be patient, be prudent. Don't let the emotions get the best part of you. And then we always put here, no matter how intelligent you are. And by the way, both of these clients are really brilliant people. One just let the emotions get the best of him. So no matter how intelligent, how experienced, how accomplished you are, nobody's smarter than the market and then market history. Bob gave me a book that's on my bookshelf back there. And one of the first pages in it is really terrific. It shows the market return over the annualized market return over every period since the 1920s. And it shows every 3-year period, every 10-year period, every 5-year period. And it shows that even including the Great Depression on an annualized basis, over 20 years, even including the Great Depression, the market's up. And I think that's really important. You can't fight that. So I think from there, I'll take a quick pause on my screen share. And I think it's time to go away from what we learned last year and into our outlook.
That'd be great.
Okay.
Absolutely.
Yeah. So here's what we're thinking. I think it's going to be a little tricky coming up, and I'm not super enthusiastic about the market. I'm not negative, but I'm not. 2 years ago, when we wrote our end of year market letter coming out of 2018, we wrote that we were very enthusiastic. We were very excited going into 2019. That's not how I'm feeling right now. Yeah. So I'll share with you what we think is ahead for us. As we look at 2021 and beyond, there are a lot of challenges out there. We've got the global recovery from the pandemic, which from an economic perspective is probably going to be okay, but it's going to be lumpy, right? The US at this point is probably going to do better than Europe. Some of the Asian economies really weren't negatively impacted. Some of the emerging economies are terribly impacted. It'll be lumpy. We're very closely keeping our eye on interest rates and inflation. With respect to that, I don't think it matters if we see the 10-year treasury, which is the benchmark that people generally refer to in terms of interest rates. I don't think it matters if the 10 years at 2% or 3%. What matters is how we get there. In general, when you have increasing interest rates, it's because there's a positive economy behind it. So if we have a positive economy and global growth is going well and domestic GDP is good and corporate earnings are great, and that kind of brings us from the 1.75 that we're at on the 10-year now to 2%, 2.25%, and it happens in a healthy way, great. If inflation takes hold and drives that uncomfortably and quickly to 3%, we have a problem. But we don't know what that's going to look like yet. So we just need to watch that play out, and we can't anticipate it. And anyone who tells you they know, they don't know. One of the things I'm worrying about a lot is the reduction of the Federal Reserve's balance sheet as they stop the huge monetary stimulation that they've got going on now and the huge buying. As that rolls off, historically, in the stock market is heavily correlated to the Fed's balance sheet. So as that plateaus, perhaps the market plateaus. Again, it's a very different scenario than it was in 2013 when we had the last, what they call taper tantrum. It's a very different backdrop, but it could be the same. So it's something we're watching closely. We think that the next year is going to be really interesting as earnings normalize. For example, I just added, and I'll touch on this later, but I just added a new company to the portfolio, H&R Block, which is the accounting firm. And it was interesting to see their 2020 revenues were terrible. Their 2021 revenues are huge. Those kind of match out. And then as you look 22, 23, 24, in those years, the earnings normalize. So that normalization is going to be interesting to see. And the way that companies, as they report earnings, the way they talk about the future, and the way that normalizes is going to have a heavy impact on the market. Tax rates are going to be interesting to watch how they play out. It'll be a big difference if the corporate tax rate goes from 21% to 25% or to 28%. It'll be interesting to see what happens with individual tax rates. We have a lot of thoughts on what they're going to do to what they may do to capital gains and dividend taxes. So I'll save that for Q&A if you want it later, Jelena.
That'd be great. Yeah.
One of the things I went into this year very worried about was the amount of leverage and margin borrowing, margin debt in the system. What happened in the past 2 weeks, there was this big dislocation with a hedge fund called Archegos. And for those of you who are watching it, there are a few positions in the stock market that got really dislocated. And I was actually reassured by that whole situation because I would have thought going into this year, if there was a huge margin debt unwinding at a hedge fund that controlled billions of dollars, that it could have negative repercussions throughout the market. I was surprised and quite relieved that it didn't. So I'm feeling a little bit about that one. And then I think this is the most challenging for the long run, the massive expansion of US government debt. I think that's going to act as a kind of wet blanket for the future. So when I referred earlier to, traditional wisdom tells us the market returns 8 to 10% a year over time, I don't know that that's going to be true. And I think the real downside to the amount of debt that we've taken out to kind of bail us out and get us through this pandemic, I think the downside is going to be suppressed growth in the future. So if maybe historically we grew on average at 8 to 10, maybe that's 6 to 9 for the next 20 years on average. Maybe it's 5 to 7. I don't know. but it would be hard for me to imagine that the annualized growth in the coming decades will be as robust as it has been in the past decades. For individuals like yourselves, this is probably going to be just fine. You know, if your portfolio returns 7% or 8%, you are going to be fine. I think where people will get hurt might be at the public pension funds. So like California State public employer retirement system, New York State, Maryland State, Ohio State, because those public plans all rely on an 8% return to continue to support the defined beneficiaries in the future. So that's who I think could get hurt. I think that can is kicked. It's going to be a long time, but when I'm worried about the repercussions for suppressed growth, that's where that comes from. Here we go. Here's the next one. In happier news. So in happier news, opportunities for 2021 and beyond, there's a lot of mean reversion that's going on. We've seen the value, the small cap, the energy, the financials, we've seen all of those out of favor strategies really pick up steam in the last 7 months. And we think that that should continue. What we've seen, and this is really cool here, I'll just get away from that boring slide. I realized I was on it for too long. One of the really neat things that's happened over the last probably 6 months is that we've seen the return of numbers come back into play over stories. So what happened, this is a kind of a lesson learned from last year, an interesting situation. What we saw happen last year was, and I'd never seen this before, I don't know that anyone had, but we saw numbers in terms of corporate earnings estimates, revenue estimates, they all went completely out the window. And it was almost like in the old days when before there was science and medicine, when you couldn't rely on those. There was hocus pocus and crazy stories and, I don't know, are you allowed to say snake oil salesman? Like there was all this stuff out there that was, that made up for science. And then I feel like that's what happened last year. So when you couldn't rely on numbers from March to really August of last year, when you couldn't rely on numbers, stories came in. So when H&R Block, for example, when you said, geez, I have, their earnings are going to be down 30% in 2020. We don't know what they're going to do in 2021 or 2022 because everything's crazy and chaotic. When things like that happened, what took up the place was like, I love DocuSign. I'm using it all the time. Doesn't matter what we pay for it. Let's send DocuSign to the moon. I'm using Zoom all the time. Let's send Zoom to the moon. And so the stories took over the investment process. And that is very, very much rationalizing and has in the last 6 months. So you see things like Zoom down from $588 a share to $320 a share. I would argue it should be a little bit lower still. Amazing company. I'm not arguing with Zoom. Great earnings potential, but there's a fair valuation for everything. We as investors ultimately care. And this goes back to the earlier thing where the short term is going to be crazy, but the long term is going to be more of the same. We as investors, anyone who lends someone their money, you want a return on it. And now we're getting back to where you can see numbers again, where you can see what's happening again. And so the numbers have taken on the traditional role that they've had in the investment process, which is you listen to the calls of management, you hear what their expectations are, you sync that up with your own expectations, you make an informed investment decision. And aside, my investment process has returned to normal, which is pretty wonderful. Last year, it was crazy. There was so much to do in terms of both buying and selling, and it was drinking from a fire hose all the time. And you had to buy something last year, you had to buy something quickly because it could be up 30% or 100% off of its lows in a week or 2 weeks. That's back to normal. Now it's a normal research process that can take the course of weeks, months, a few days, however long it needs to take, but it's normal. It's not needing to buy 10 stocks all at once. It's not needing to sell 5 stocks all at once. It's just a normal, this one needs to be sold, this one needs to be bought. The pace and process has returned to normal. Another really neat opportunity that we're looking at in 2021 is that because, and this cuts both ways, because of the prevalence of momentum investing and index investing that's taken over the market, we actually think that there's a huge opportunity for active investing that hasn't been there in a long time. As my partner Greg says, if you want to pair me up versus a robot, I know I'm going to win. And so we think of ourselves frequently as it's us making informed decisions versus the robots right now. And there's a big opportunity. This is cool, but there's a firm called Willis Towers Watson and they're a big advisor to large endowments and pension plans. And they actually put out a huge white paper talking about the opportunity for active management that hasn't been there in a long time. So that's really positive for us at Gilman Hill, and we can get behind that. We think, the pendulum always swings too far. Right now, it's swung too far in that direction. And then lastly, here we go. And then lastly, we think that global growth has been actually kind of surprisingly resilient. It's easy to make things scary coming out of the pandemic, but the reality is global growth coming out of the pandemic overall broadly has been quite resilient. And that is very reassuring to us. So from here, are you okay with me jumping into dividend specific, or should we take a pause?
No, go ahead. Go
Okay.
ahead. That'd be great. Thank you.
Okay. So all of this feeds into our portfolio, which is a dividend income portfolio. And I do want to differentiate. There's a difference between dividend income and dividend growth. So dividend growth portfolio might have the same total yield as the broader stock market, but the dividends are growing quickly. In our case, the objective is to have a high, large component of the total return come from dividend income. So our portfolio's objective is to generate a 5% or better dividend yield with growth over time on top of that. It's kind of neat. I had the opportunity to write a chapter for a book earlier this year. It's called How I Invest My Money. And they did an illustration for each chapter. So this little chart is the illustration for my chapter, which is dividend income plus emotional comfort buys you time. And going back to what we were talking about earlier in terms of lessons learned, what I realized this year is one of the best parts of the portfolio that I manage is when you can tell your client, you put $1 million in, you put that $1 million in because you expected to get $50,000 a year of income. And that income's helping you live in whatever way, if you need to take the income, or it's buffering your portfolio because $1 million $50,000 on your million is paying in. That brings tremendous emotional comfort to a lot of people, not to everyone, but to people who want it, it brings tremendous emotional comfort. And when I think back to the worst of March and April of last year, the fact that we were able to say to our clients, your portfolio income is there, it's safe. And yeah, you know what? Some of the stocks in the portfolio, they quit on us. Some of them cut the dividends. Oh, well, what we're going to do? We're going to replace them. This is my new analogy that I just came up with. But I realized that managing a portfolio is very much like managing a business. And I'm sure all of you, work in a business, own a business, have been part of a business. And it doesn't matter if it's 10 people, a small firm like ours, or 150 people. But if you think about it, if let's say your business is 50 people, let's say 2 of them are out sick. Well, you know what? Other employees roll up their sleeves and they pinch hit, and the business marches along and revenues come in because of that. And let's say 2 of your employees quit. You know what you do? You rehire them. That's exactly the same as managing a portfolio. And in my case, in my portfolio is about 32 stocks. And those 32 stocks are my employees that I've hired to make money for my clients. And last year, more of them than usual quit. And that's just part of managing it. So you know what we did? We sold them and we rehired. We bought new stocks. And the portfolio income remained intact. And a few of them got a little bit sick where they cut their dividend income for a short amount of time and then reinstated it. But that's okay because other companies were increasing their dividends. So it's a pretty cool thing to actually have this concept stress tested twice. First, it was stress tested, I would say, really significantly in 08-09, which was a long, severe, drawn out, awful recession, but the income remained intact. And then last year, it was stress tested again in a very different manner, which was short, severe, total shutdown. And in both those cases, my clients were able to get the income that they expected to again, either live on or to buffer the portfolio. So here I'm going to share another slide. This is kind of neat. I think it's neat at least. So this is a picture of the income that our portfolio generates. And this goes back to 06. And you can see there's dips, but then there's very sharp rebounds from those dips. So for a short while, the average income might have been down, but then it bumped right back up. But you can see that starting in 06, this is if you'd invested $1 million with us in 06 and what the income would have been. But what you see is basically even through 08-09, the debt downgrade, Ebola, oil prices plunging, the China global growth scare, and even the pandemic, that income remains incredibly steady. And for some people, that's just a nice, comfortable, reassuring part of the total portfolio. for us, we really look at it, this is a little cheesy, so sorry, but we really look at it as a strategy that can provide a ballast in periods of market turmoil to help people get through it. Again, going back to the behavior and those slides that I showed before that said if you miss the best 40 days, if you let your emotions get the best of you, you get 2.1% versus the 6.1% for the market. We think this portfolio can help people maintain that long-term horizon because they know they're getting something. And you can say, well, you put $1 million in, it's generating 50,000. If you sell it, you're done. You don't get your 50,000. And that concept can be very, can help lead to like really good emotional behavior by investors. And then it definitely discourages the temptation to pursue stocks whose valuations have outstripped their cash flows. So, not to pick on DocuSign and Zoom too much, but those are kind of who we're thinking about there. This is pretty crazy. A year ago, we shared this with you, which is the idea of generating income naturally versus needing to manufacture it. 30 years ago in 1990, 31 years ago now, in 1990, if you had a portfolio that was invested in half stocks and half bonds, so the S&P 500 and the 5-year treasury, that portfolio would naturally generate $56,500 a year of income. So when you think about, but my parents had dividend income, my grandparents always had dividend income, they lived on that dividend income, it was great. That came to them naturally as part of their overall portfolio. That doesn't happen anymore. And that's a whole other webinar for me to talk to you about why interest rates are so low and why dividends are so low. But let's just leave it alone for now and say that they are. So that was last year when I presented to you. Guess what? Things have gotten even worse. It's even crazier now. So check this out. Hold on, here we go. This is this year. So last year when I was talking to you, that same portfolio was down to $17,950 a year. Now, because interest rates have come down even more, and dividend yields, because the market's up so much, the dividend yield of the S&P is even lower. Now, that same 50-50 portfolio of stocks and bonds only yields $12,500. So if you want income, you don't get it as a natural byproduct the way you used to. You need to seek it out now. It's different than it was. So from here, I thought it might be fun to either we can do questions or I have a few stock stories of the kinds of companies that we invest in because I feel like everyone likes a stock story. So Julina, what's good for you right now?
Yeah, well, let me there's so much valuable information that you just put out at us. Let me pause for a minute with just maybe a couple comments and questions, and then I would love to end with you on some of the ideas. I think those are always interesting. So, the basis of your presentation has really been around the emotions. Mm-hmm. And we've seen this over and over again, right? On how emotions can ruin the return. Yeah. And it's intriguing to me because you as a portfolio manager, you talk about you need to cut through the noise. But Jenny, you're also human, you're a mom. How did you do that in the last year? I mean, that had to be incredibly challenging.
So I don't think this is different for me than for any other professional, right? Like if you were a firefighter, like you look at firefighters and you're like, oh my God, how do they go into the burning building? Like they're trained. Right. You look at a surgeon and you're like, oh my God, you got someone's brain open. Like, aren't you terrified that you're going to kill the person? Like, no, they're trained. And this is training. Yeah. And I have a very good education. And I think I've realized how important that was in this path. This is another lesson learned.
Okay.
I started interning when I was 19 years old and I had amazing internships at portfolio management firms. I learned from Harry Keefe, who founded Keefe Bretton Woods. I interned for Laszlo Barini, who is a brilliant market strategist. And for those of you who used to watch Louis Rukeyser, he was one of the frequent guests on Rukeyser. I worked at Goldman Sachs. I worked at Neuberger Berman, where I had an incredible education. I went to Columbia Business School, where I got another amazing education. And I've been doing this for 25 years. And one of the things my partner Greg and I have talked about a lot was last year in March, we kept reminding ourselves we didn't become idiots overnight. And because we knew we weren't suddenly idiots with the market down so much and our portfolio down so much and us not having seen what was coming, nobody saw what was coming. Right. But because we knew we hadn't become idiots, we were able to then rely on our education, which was to say things like, here's a company, Unum, that I added to the portfolio. It's earning $3 a share. It's trading at maybe then it was earning $4 a share and trading at 4 times. I think I bought it at $16 a share. I might be mixing it up with Interpublic Group. But when you see a company that's got $4 a share of earnings and $1 a share of dividend. And you can look back to its history through 08, 09. And you can say, they didn't cut their dividend then. And you can call up the company. And I spent so much time on them. Like, explain to me why you didn't cut your dividend in 08, 09 and why your peers did. And you can understand what their investment portfolio looks like and you understand their business. Then you're comfortable and you're confident, like the same way a surgeon is or the same way anyone in a crisis thing. So I really, last year, more than anything, I appreciated my education and I appreciated, you probably can't see them, but like all these gray hairs, like those things, they're pretty beneficial. I know I look so young. I couldn't have gray hairs.
Yeah. Thanks Zoom for the close profile, right? No, I appreciate
with wisdom or wisdom comes with those. I don't know.
Yeah. Well, the other thing you mentioned is you talk about the struggle of a balanced portfolio, right? The media loves to talk about the challenge of a 50-50 or 60-40. And so with that, you see a lot of clients go and quote unquote chase yield. But your portfolio, Jenny, is yes, you're focused on yield and income, but you're not going to go and just buy the highest paying yield. Can you clarify? Because I think that's really important with some challenges that people face when they just go and quote unquote chase yield.
Yeah. Thanks for bringing that up. So I actually was able to participate in a pretty cool article written by a guy named Lawrence Strauss, who's a Barron's writer. And one of the things that I got into in that article, by the way, is called Yes, You Can Retire on Dividend Income. And it came out 2 weeks ago. But one of the things that we talked about in that article is that as a high dividend manager, right? And again, this is not dividend growth, but high dividend, it needs active management. So a lot of strategies can just be based on quantitative statistics, can be totally objective and just say like, use a screening process. This cannot. So every week we run a screen and we say, show us everything in the US that has above a 3.5% dividend yield and above $100 million market cap. And as I told you before, the portfolio is about 32 stocks. Mm-hmm. So you really need to be an active manager to weed out which of those can actually give you that income consistently. And it's a hard process. And it's things like calling Unum to understand why that dividend stream is intact and why it will maintain, why it's durable, why it's resilient into the future. Right. Other strategies aren't that way. Other strategies you can screen for, but there's a lot of nuance here. And there are a lot of what we call value traps, where the share prices plunge, suddenly the dividend looks interesting. And you can see like, oh, well, they paid a dividend for 10 years. But the reality is there's like a secular shift in that business that you don't want to be part of. So this niche of the investment world needs something dedicated and focused. And it's why we run a competitive analysis. We run it every quarter. There's not really any competition for our strategy. You can look at dividend exchange traded funds, and the good ones they all have yields kind of in the 3% range. Anything that's higher tends to use a lot of leverage. It gets dicey. The returns can get really spooky. I've looked at a lot of mutual funds that are billed as high dividend income. And what you see there is it'll say something like, oh, it's 15% in consumer staples. Well, doesn't that sound wonderful? But then you dig into it and it's 5 tobacco companies, each with a 3% weighting. So that's not really that great either. So really it's a niche and nuanced strategy that needs to be done carefully. And it's not a strategy that could manage 10 or $20 billion. It needs to stay small and kind of go beneath the radar. And this is an aside, but like, this is why I want to work with you guys and why I would never, ever work with a Morgan Stanley or UBS. It couldn't handle the volume and actually maintain the integrity of the strategy.
Well, thank you for saying that. And, and I think what you just articulated is so important, because just because two strategies say they're doing the same thing, or Morningstar categorizes you, for example, when you look under the hood and you realize how different they are, you have to understand that some of those nuances can have a different effect, right? And so I think that's incredibly important. And that's, as you know, we have our monthly investment committee meeting, and this is part of what we talk about, is understanding the strategies to have an idea of what it's going to do for the clients. So that's great. And then also last question here on the dividends. President Biden is proposing a change in how dividends are taxed. Can you talk a little bit about that?
So this is really interesting. And I would say everyone watching this, like, take a deep breath. It's probably not going to affect you. So the conversation at this point is that that the dividend tax would go up for people who make over $1 million a year. And this is cool too. There was another Barron's article with the same writer who we got to put some input into this conversation about 3 or 4 months ago. And I'm happy to share that article because it fleshes it out a lot more.
Yeah.
But it's very different. I don't know if you all recall in 2012, superficially the same conversation was happening. And the thought was that at the end of 2012, the dividend tax, the 20% and 15% and 20% dividend tax would expire and it'd go back to the ordinary income rate.
Right.
So if that had happened, it would have affected a lot of people. And it would have changed the way companies deal with their capital allocation, the way they would have thought to pay out the dividends. This is different. This is saying for people earning over $1 million, it will change. So you know what we did? We looked at how many people in the United States earn over $1 million a year. And it's about 500,000. There's about 500,000 households that earn over $1 million. The reality is for many of the households that earn over $500,000, they don't rely on dividend income. It's normal people. It's people who have like $3 million or $10 million or $1 million and they need 50 or 100 or whatever it is, but it's not people who are earning $1 million. So I think it's interesting to think about IBM, and they would never, ever say, oh, we're going to cut our dividend because it's a bad, it's a tax inefficient capital allocation, because 500,000 households are going to start paying a bigger tax. Meanwhile, there's millions of shareholders,
right,
of AT&T and IBM and Dow and Verizon and all these companies. There's millions who rely on those dividends to actually support their lives, and the new dividend tax is going to have no impact on them. So I think what sounds superficially like something scary actually is going to have very, very little impact. If I think across our client base, I think we have 2 clients who would be affected, and I think that in and of itself is quite telling on what the real % of people being affected is.
Yep. No, that's great. Thank you. And I guess lastly, we always get the question from clients. They always want to know what you're doing in the portfolio and if there's anything you can share. So I feel like this is dessert time.
I know, right? I'll share my new one. Okay, so I'm going to switch to share my screen, and I'm going to show you our newest purchase because I'm quite excited about it. And I kind of mentioned it before, but our newest purchase is H&R Block. And I think this is a really interesting investment. I was really, really excited about it. So this, how I said before, we run a screen every Monday and it says, show me everything in the US, 3.5% dividend yield or better, $100 million market cap. But then from there, we narrow it down. So H&R Block's been on there for a long time. Interestingly, this comes through, not as a financial firm, not as a technology firm, but as a consumer discretionary firm. And it doesn't really fit anywhere. What's particularly cool about this is that there's a relatively new CEO named Jeffrey Jones, and he came over from Uber, where he was the president of Uber. So he comes to this company with a technology, like a high-tech background. And to me, if I were him, I'd be like, oh my God, this is incredible. I'm going to flip back to this in just a sec, but I'll stop sharing. This is incredible, right? All these VC guys out in Silicon Valley who are starting fintechs, which if you've heard that term, it's financial technology. What do they want? They want to earn $1 billion a year. They want 22 million clients. Well, H&R Block already has that. And so he probably came here and said, whoa, we're minting cash. We're going to earn $2.50 a share. We're already paying out $1 a share of dividend income. That's very important to us. And that's very important to me too, to see that coverage. But they're minting cash. They don't need to go groveling through the Silicon Valley, venture cap and private equity crowd to beg for money to fund future growth. It's already coming in. And they're looking at it and they're saying oh, we have all these opportunities and we can build out our digital platform. We can start to work with small businesses. Interestingly, and this is one of the many reasons I love my job, but it was really cool in going through their investor day. They did a really great investor day in December. Going through their investor day, they put a slide up of the new business applications new small business. You would not believe the number of applications for small businesses that emerged last year. It's unprecedented. And I've been hearing over and over, small businesses are what will save us and drag us out of the pandemic.
Yeah.
And so they see that as a huge opportunity. So here we have a company that was still down a bit from where it had been trading pre-pandemic. Why? Because the earnings got mixed up, because nobody needed to do their tax returns in 2020. Everyone's hand over fist doing them in 2021. So it's hard to see it, but you look forward and you see $2.45 of earnings, $2.60 of earnings. They have a lot of operational leverage. They think that they can grow their revenues at 3 to 6%. That translates to earnings growth of 7.5 to 15%, plus a 5% dividend yield. It's very exciting. And I want to show you one more thing on that slide. This is really, really important. If you look here, if you can see the graph on the upper right, the light blue line is the share price and the red line is the dividend. And so you can see that while the market's kind of crazy and emotional and chaotic, the dividend income is not. And the dividend income is what's reflective of what the inside of the business is. So I think I've been able to buy this stock at a sharp discount to where it really should be traded at 10 times earnings. And I'm going to get 5% dividend, and they're committed to growing that dividend. They think that they can grow the earnings. And I think that because it kind of doesn't fit into technology or financial services, it got left out. But I don't think that that's going to persist. I think when I said before, numbers are coming back and crazy stories are out, I think this is one where the numbers are going to come back and people are going to say, whoa, 10 times earnings, 5% yield, new CEO who sees a huge opportunity. Like, what a wonderful little gem this is. Right. So that's my newest. And I think that's very reflective of what's in the portfolio. I mean, there's big stuff in there too that everyone knows, like AT&T and Verizon and AbbVie and Pfizer, but it's the H&R blocks that make the strategy unique and go back to why it needs to be actively managed and why you can't just run a screen to pick stuff up.
Absolutely. No, thank you so much, Jenny. And, in summary, I'm kind of looking at my notes and realizing that the markets are still emotional. They're going to remain emotional. So we have to just mentally prepare ourselves for that. I love you confirming the fundamentals of what you're doing with the portfolio and how you maintained through that. And, you talked about the challenges for 2021 and beyond, but also the opportunities. So I think it helped clarify a little bit of light at the end of the tunnel is my hope. So as always, we really appreciate your insight. We appreciate your dedication to your clients. And again, your team has been a great partner of ours. So we look forward to the continued growth going forward. And also, I want to thank everyone for taking the time to join us on the webinar today. So we appreciate it.
Thanks, Julina.